All right, so what I want to discuss is how not to be a sucker when you are trading short-term trades.
This is Sky Type 2 and Happy Kitty Major Coins.
And I want to discuss 3 points. I want to talk about just understanding the process of trading short-term trades. You have to learn the process. You can't just jump in it and think that you understand it because short-term trades represent the most risk when you're trading options because it has what is called gamma risk. Gamma risk is the rate of change, or gamma is the rate of change of delta, how fast that directional risk is changing based on a percentage amount. And if you're trading stuff that is longer term, especially that this kind of stuff that Ernie does that's over a year, you darn near have zero gamma risk. And you can argue, and I can argue that when you're doing bread and butter 30 to 60 days, you don't experience gamma risk. But when you're doing stuff that's inside of 15 days to expiration, and every day that it gets closer to expiration, gets closer to that zero DTE type of trade that's really popular out there right now, those zero DTE SPX trades or ES trades, or sometimes people are doing it on Amazon and Tesla. That is the most gamma risk, right? So you just don't want to jump into those type of trades without understanding the process, about learning the process. You want to start with stuff that's a little longer out so it can give you a chance to see how things move, see how things fluctuate, see how things move out, how fast things go, and get the nervousness out, give you a chance to actually learn the platforms a little bit more and things like that before you're jumping into something that is like, race car driving, right? You start with the go-karts before you start trying to drive in the Indy 500 or something. It just doesn't make a lot of sense how some people jump into zero DT trading or short-term trading period without understanding a process such as, okay, where should I put these trades? Should I do a put spread? Should I do an iron condor? Should I do it at a 5 delta or a 10 delta? Should my spread be 50 points wide or 10 points wide? What should it be? What should the processes of that trade be? And then when things go wrong, what should I do? Should I do what the Dorian Way says is a roll away? Should I do a stop loss based on how much credit I receive? Should I roll it out? Is it a combination of all of those things I can use? You need to have the plan, right? You need to have a plan. You do not want to be a sucker and be enticed into doing short-term trades and lose your monies in a significant way. People are losing their monies a lot in short-term trade because they do not understand it. But if you do understand, if you learn the process, you put in the time, then yeah, you can make the most type of percentage-wise income and performance from shorter-term trades. But it doesn't necessarily mean you should do it. Right? You can still make a lot of money with 30 to 60 days. You can still make a lot of money when you're doing something that's over 365 days. It's a number of different ways you can make money in the market. You need to find out what works best for you, and you don't want to be a sucker and get enticed into stuff that just doesn't work well for you, or you don't understand. Or you don't understand. All right. So let's look at doing a short-term trade now, and let's talk about not being kind of fooled by the probabilities of the kind of trades. All right. So if we're going to do a short-term trade, and let's look into the SPX, and we'll also look into the ES really, really quickly. But I'm just going to give you some criteria. We're not going to do a zero DT trade. We're going to do a 1 DT trade. You want to understand what's going on the next day, and you have to be okay with if it's news coming out that next day, if you're going to do a 1 DTE trade or you're going to do a 0 DTE trade, especially these 1 DTE trades, because usually the news comes out about an hour before the market opens. So that can affect your trade. If you're trading in the SPX options, you're not going to be able to adjust that until the market opens. So you have to be willing to deal with that overnight risk, and especially that economic news risk. And so that's the case in this scenario. When you're going to do this, you want to break it down by following these type of steps. You want to see what is the VIX, what's the rule of 16 with the VIX, what is the expected 1 day percentage move. So you take the 1665 and you divide it by 16. That's basically going to be a 1% move. The market is expecting tomorrow we can go up 1% or down 1%. That's what the VIX is expecting. You can also look at your platform's expected move. So this is the expected move that TastyTrade is saying, plus or minus 22 basically. I'm rounding up. So normally in the Dorian Way, we're trying to do 2 times that expected move. So if it was 22, we'll want to be at least 44 points away. I also want to look at the straddle price. So I look at the straddle price, and this you can get this on any platform. If you understand an option chain, you just put in the straddle price. The straddle price right now is saying 24. I like to round it up. I know it's closer. If you're doing any type of rounding, it's closer to 24. But I want to round it up because I'm trying to give myself the best probabilities possible, and I'm trying not to be a sucker based on probabilities and expected move, because they can go a lot more than what is expected, and they do it often with these short-term trades. So you have to be aware of that and understand your strategy of getting out or adjusting the trade, because you're going to have to deal with that in these markets. If you were trading it today, most likely almost 100% you had to adjust that if you did a zero DTE trade today based on how much we've moved. This last few minutes has hurt some people, right? We were just what, when we got on the call, we were probably only up 5 points or 4 points. Just before we got on the call, we were down a little bit in the ES, in the S&P 500. So it's jumped up a lot. So I want to be at least 50 points away if I can be, right? That's the kind of criteria how we use to set it up. And then we start at the 5 delta. So if we go to the 5 delta and then say this is a 5 delta, then you decide how wide you want to do the trade. So let's say we're going to do a 20-point wide here. And then on the put side, let's say we're going to do a 5 delta, and we're also going to do a 20-point wide spread. So once you've got your spread, and then you're going to eventually calculate, are you 50 points away on the put side? Are you 50 points away on the call side? Are you at least 1% away on the put side and the call side? You're going to figure all those things out. We just took those numbers. We're going to figure that out, right? That's what you want to do. But you also need to figure out how much dollar amount did you want to receive. Do you want to receive $80? Do you want to receive $100? Do you want to receive something more than that? And you have to base it on your account, right? So you don't want to lose a lot. You only want to lose at best, if you have a decent size account, 2% of that account. You want to only risk 2%. If you have a smaller size account, sometimes you have to risk more in that account just to be able to play the game. So maybe up to 5% there, right? But if you have to risk more than 5%, then you shouldn't be doing these short-term trades, because your account at this point is a little too small. So you should move it. You should do something that is not short-term, right? So don't be a sucker. Don't be a sucker. All right. So in this example, if we take, so we just got filled with that 70%. Boom. That was beautiful, right? So I didn't think it was going to happen today, but that's how volatility comes out of the market. I said it happened Friday, so I'm a day and a half, out of touch here, or it happened a day and a half faster than I thought. But that's beautiful, right? That's beautiful. And whenever you get something happen faster that's a benefit for you, you take it. Okay? So now we're putting on this another short-term trade in this SPX, and let's see how far we're away point wise from at the money if we did this 40.80. So we take the 41.42 and we minus the 40.80 strike price. I'm just taking this strike price, everyone, and that's 62 points away on the put side. On the call side, if I take this 41.95, this strike here, and I subtract what it's currently trading at, so 41.95 minus the 41.42, that is 53 points away. So we are 2 times the expected move away on both sides of this SPX trade right now, and we're doing a 20-point wide spread. Okay? So that's giving us what? It's going to require about almost just under $2,000, or just above $1,900. We're only getting $75. Right? We're only getting $75, but we do have some economic news coming out tomorrow. And we moved a lot today, but we're inside the expected move. I believe the expected move yesterday was about 35 points. So we're inside that expected move. Are we going to move outside of that expected move tomorrow? Because we didn't move outside of it yesterday. So trying to be as vigilant as possible and not being a sucker and not letting probabilities fool me, I'm going to stay far away, and I'm going to look to do this trade here. Right? So this is going to give me $80 if I'm able to do this trade. I like it. Things can change in the next 30 minutes, but let's look at this really quickly. And let's go here. We're going to put in $80, and we're going to send that. And then what we can also decide is, do you want to do it in the the ES? We're going to do it in the SPX in this account today, but you might want to do it in the ES if you have a smaller account, and if you need to adjust and so forth. It's better to do it in the ES because you don't have the day trading pattern rule. But if we did the same kind of concept, right? And let's go to the 6 delta over here, and do a 20-point wide spread. That would take us to here. And then if we go to the put side and we went to, let's just say we went to the 6 delta. Well, I don't like that 6 delta. Let's go to this 4100. This 11 delta here, but it's still more than 50 points away, right? And do a 20-point wide. So here you're getting 160, and this is $80. So basically the same amount that we're trying to get for the other one. And you can argue that maybe I should do this and let this and see which one gets filled. And I would understand that and agree with that. But we're going to let it play out just for a few minutes. We got 32 seconds to go here. So Once you put the trade on and you get filled, you want to make sure you understand how you're going to exit the trade. You're going to not only your profit target, but your risk management target. How are you going to get out of the trade? Are you going to adjust it? Are you going to get out based on a 3 times the stop loss, a 2 times, a 4 times? You need to understand that, and you can learn more about that in the Dorian Way video library. And we talk about the 1 to 14 day 0 DT trades or short-term trades and the day trading category that we have in the Dorian Way school. I do want to point out that you do not want to be fooled or be a sucker based on how much you're trying to make. Right? So if you have a $10,000 account, for example purposes, you can't come to short-term trading saying, okay, I want to make $10,000 a month. Well, that's 100% each month. That's not going to be sustainable. You'll be lucky if you can do that one time. If you made 2% a month, that's excellent. You made 5% a month, that's excellent. 10% a month is absolutely extraordinary. If you can consistently do that, right? If you can consistently do that. All right, so that's what I want to discuss. We just got filled on that trade, so it's in the books now, and we're going to see what happens tomorrow. You can see that the market just jumped up some more. We're at the $80 that we received.